The future of peace between Iran, the United States, and Israel remains one of the most important geopolitical questions for global markets. While nobody can predict the future with certainty, there are reasons for both optimism and concern. On one hand, recent diplomatic efforts suggest that all sides have incentives to avoid a full-scale war. Iran seeks sanctions relief and economic stability, while the United States aims to reduce tensions in the Middle East and prevent disruptions to global energy markets. Israel prioritizes national security and preventing Iran from expanding its military capabilities. Recent negotiations and temporary ceasefires show that diplomacy remains possible, even after periods of intense conflict. Analysts believe that economic pressure on all parties creates incentives for compromise and de-escalation. However, achieving lasting peace remains difficult. Deep political disagreements over Iran's nuclear program, regional influence, and security concerns continue to divide the parties. Even if temporary agreements are reached, isolated military incidents or political changes could quickly increase tensions again. Experts warn that any peace deal remains fragile unless long-term solutions are implemented. From a market perspective, peace and conflict create very different outcomes. If peace becomes permanent, global markets could benefit significantly. Oil prices may fall as Iranian exports return to international markets and shipping through the Strait of Hormuz remains open. Low oil prices often reduce inflation, allowing central banks such as the Federal Reserve to keep interest rates lower. This environment usually supports stock markets, especially technology companies, consumer businesses, airlines, and manufacturing firms. Investors generally react positively to geopolitical stability. Recent reports already show that hopes for peace have lowered oil prices and improved market sentiment. On the other hand, if conflict escalates, the effects could be severe. The Strait of Hormuz is one of the world's most important energy routes, carrying a large share of global oil shipments. Any disruption could cause oil prices to spike sharply, increasing inflation worldwide. Higher inflation may force central banks to raise interest rates, putting pressure on stocks and economic growth. Safe haven assets such as gold, the US dollar, and government bonds often rise during periods of geopolitical uncertainty. Certain sectors would be affected differently. Energy companies could benefit from high oil prices during conflict, while airlines, transportation firms, and energy-intensive industries may suffer from rising costs. Defense companies may also experience increased demand during periods of military escalation. Technology stocks, which are sensitive to interest rates, could face pressure if inflation rises.